So good afternoon and welcome to everyone. This is our 714th meeting of the Economic Club of New York. And I'm Barbara Van Allen, President and CEO of the club. As many of you know, the Economic Club is recognized as the nation's leading nonpartisan forum for discussions and speeches on economic, social, and political issues. More than 1,000 prominent guests have appeared before the club over the last century. And we've established a very strong tradition of excellence, which is continuing up to today. I'd like to extend a warm welcome to students joining us online from CUNY Graduate Center, Rutgers University, and Columbia University, as well as members of our largest class ever of 2023 fellows, a select group of diverse, rising, next-gen business thought leaders. Today, I'm honored to welcome back Lael Brainard. Lael is the 14th director of the National Economic Council. Prior to this role, she served as vice chair of the Federal Reserve, undersecretary of the Treasury for International Affairs, and deputy director of the National Economic Council. She was also vice president of the Brookings Institution. Lael received her master's and PhD in economics from Harvard and was an associate professor of economics at the MIT Sloan School of Management. The format today will begin with a speech by Lael, followed by a conversation in which we're delighted to have chief economist at Moody's Analytics, Mark Zandi, doing the honors. 2 days in a row, we've had Mark, which is wonderful. Time permitting, they will take audience questions from the room. As a reminder, this conversation is on the record, and we actually have plenty of media on the line and in the back of the room. First, I'd like to ask Lael to come up to the podium to share her opening remarks.
Well, it's great to be here. And Barbara, thank you for inviting me. Thank you for the kind invitation and the introduction. And I'm looking forward to having a conversation with Mark. So let me just start with the recent data. They suggest that the US recovery is solid and inflation is down. Unemployment has been fluctuating in a narrow band below 4% for 17 months in a row, which is the longest stretch in about 50 years. The share of working age Americans who are employed has risen to highs not seen in 20 years, as you recall, after touching lows not seen in about 45 years. And real earnings are now higher than they were before the pandemic. In a very important development, the labor market is now in much better balance than it was even 6 months ago. American workers have defied predictions that many would not return to the labor force following the pandemic. Recent months have seen the labor force participation rate by prime age workers rise above pre-pandemic levels, and even the participation rate for the overall workforce is now above its pre-pandemic trend. This has occurred as vacancies and payrolls have moderated. The economy is defying predictions that inflation wouldn't fall absent significant job destruction. Just today, we saw new and encouraging evidence that the economy is on the path to moderate inflation accompanied by a resilient jobs market. Annual CPI inflation is 3%, which is very close to the 2.9% average level that prevailed in the nearly 2 decades leading up to the financial crisis. Inflation is now the lowest among G7 nations in the US for both headline and core, even as the recovery has been the strongest. While declines in energy and food prices have been important in bringing overall inflation back down, core inflation is also declining, and it's projected to decline further as rents decelerate. The closely watched category of non-housing core services has been running over the past 6 months at about 3.3%. That's actually close to the 3.2% annual average level that prevailed in the 3 decades prior to the pandemic, and of course, excluding the financial crisis. It'll be important for corporations to continue to bring their markups down after having raised them to unusually elevated levels over the past 2 years, which would help in reducing inflation. The markups associated with price spirals, when final goods prices go up more than input prices, should unwind if consumers are more price sensitive and firms have to compete more intensely. Those economic gains haven't happened by chance, and they won't be sustained absent a deliberate strategy. President Biden's strategy is aiming to grow the economy from the middle out and the bottom up, which is a fundamental shift from a top-down economic approach that too often drove economic policy making in the past. In that kind of an approach, it emphasized cutting taxes at the top and held that government should mostly get out of the way. But the benefits from these policies weren't broadly shared. We did see tax cuts adding trillions to the national debt, but we didn't see gains in real wages or investment. We saw inequality increasing, and many communities suffered from sustained disinvestment, as did investments in infrastructure. Those policies left America vulnerable to a series of challenges that I'll touch on just briefly before turning to current policy. First, of course, China's state-led approach to its integration into the global system resulted in profound dislocations in patterns of production and manufacturing workforces around the world. America remains among the most open economies in the world, and we are strong supporters of the global arrangements that America has led. But we also now know that for growth to be broad and sustained, it's vital to make public investments in our own economic future to safeguard strong pathways to the middle class in communities around the country and to ensure our supply chains are resilient. Similarly, the global financial crisis took a severe economic toll on the livelihoods and wealth of middle-class Americans, and we saw that there is actually great risk associated with trickle-down's preference for deregulation and indifference to concentrations of market power. More recently, the waves of the global pandemic and Russia's war on Ukraine revealed surprising fragilities on the supply side of our economy that contributed to shortages and a surge in inflation. That experience highlights the importance of investing in the supply side of our economy to make it more resilient. Of course, we face additional challenges ahead, including those associated with climate change. We can either adopt smart policy to build the clean energy economy so that it benefits American workers and communities and the overall economy, or face the transition and physical risks associated with climate change that are now apparent in every state in the nation. We have secured historic legislation to prepare the nation to better adapt to change. President Biden's agenda has 3 pillars, and I'll just briefly mention each of them. First, we're making smart public investments in order to catalyze private investment in infrastructure, semiconductors, and clean energy. We've seen over $500 billion in private investment in these industries, and real manufacturing construction spending has increased by nearly 100% since the end of 2021. Mainstream economics has long recognized there is a role for public investment to complement private investment in targeted areas where private returns may not reflect the overall public benefit. Public investment in infrastructure as a share of the economy had fallen by more than 40% over the previous decades. And this was a concern that was broadly shared on a bipartisan basis. To turn this around, the bipartisan infrastructure law is leading to investments in tens of thousands of projects around the country to repair and rebuild roads and bridges, airports, rails, and ports. And in the same spirit as FDR's rural electrification plan, President Biden's broadband initiative is a generational investment that will connect every household and small business in America to high-speed internet. Semiconductors are essential intermediates, but the share of global semiconductors produced by the United States has fallen by 2/3 since the 1990s, in part due to large-scale investments by foreign governments. We saw the effects of that when shutdowns of fabs far from our shores disrupted supply chains and led to really sharp shortages in a whole range of goods in the US economy. With the help of the CHIPS and Science Act, we're seeing private investment in semiconductor manufacturing and R&D with the potential to achieve important synergies with America's robust semiconductor user base and design ecosystem. And of course, smart public investments are also critical to encourage the private sector to invest in the clean energy transition, which is why the Inflation Reduction Act provides tax incentives for clean energy technologies and investments. We're doing this in partnership with our friends and allies around the world, working together to drive down costs and advance the frontier for technologies that are likely to be deployed globally. The second pillar of the President's economic strategy is empowering and educating workers and ensuring a brighter future for communities that have been left behind. Over the last 30 years, we had seen a decline in the convergence of incomes across states and metropolitan areas. Research suggests well-targeted place-based policies that provide incentives for private investments can create good quality jobs, particularly in areas that have underused infrastructure and a skilled workforce. So the Inflation Reduction Act creates and funds incentives, for instance, for private clean energy investment in areas with existing workforces and infrastructure that are well suited to some of the industries of the future. And that includes solar and wind energy projects. And the CHIPS and Science Act similarly is helping to strengthen the capacity of communities with high unemployment to enable them to compete for more investment. A variety of policies investing in education and training, ranging from a commitment to free and universal preschool and free community college to increases in Pell Grants and registered apprenticeships and CTE, career and technical education, are intended to provide more pathways to family-sustaining jobs and good careers, even for those who do not pursue a four-year degree. And the final piece of the agenda, of course, is promoting fair competition and lowering costs. That is why early in this term, the president issued an executive order that made promoting fair competition a whole of government enterprise. That competition agenda is helping to lower costs for middle-class Americans. So, for example, a rule issued by the FDA enabled hearing aids to be available over the counter for the first time. And that lowers the prices of these essential medical devices by $3,000 for the 30 million Americans with hearing loss. Similarly, the out-of-pocket spending cap that's saving seniors hundreds of dollars a year and up to $2,500 a year for some. Similarly, the $35 per month cap on insulin is saving seniors often hundreds of dollars a month. And this simply comes by introducing greater competition. In the weeks and months ahead, we're going to continue working diligently to support growth that is more resilient and broadly shared through smart public investments, educating and empowering workers, and lowering the cost of living. And now I'd be happy to turn to questions. So thank you very much.
So, Lael, you picked a great day to come talk about the economy, didn't you? The CPI number was about as good as it could possibly be, 0.2% increase on top line and core inflation. And if you look at the details, the slowing in inflation appears broad-based across lots of different parts of the CPI. Time for a victory lap?
Well, look, I think every day is a good day to talk about the economy for the reasons that I mentioned earlier. Inflation is coming down, and it is now close to some of the historic experience of more normal levels of inflation. And as you said, the numbers that we're seeing are now quite broad-based. So core inflation is also coming down, and the very watched core non-housing services in particular has shown over the 6 months a very notable decline. And of course, that is particularly true over the last 3 months. In terms of housing services, we also expect that to be coming down just based on the catch up of average rents with some of the rental price indices that we've been seeing for several months now. So that trajectory is good. And we're also seeing a very resilient labor market with moderating payrolls, moderating vacancies, and the highest employment to population ratio for working age workers that we've seen in several decades. So for all those reasons, I think there's good data to support future resilience. But of course, in order to see that, we're going to need to continue working diligently.
So is that a victory lap?
So again, we're seeing resilience, but we're going to have to work hard to ensure continued resilience.
Got it. Well, despite the good numbers today, inflation is still high. I mean, the core CPI, 4.8% year over year. That's still well above, I think, what anyone would feel comfortable with and above the Federal Reserve's target for inflation. And for many American households, inflation is the number one economic problem. Unemployment is very low. People have jobs. Wage growth has been pretty good, but they're worried about inflation. And for many Americans, this is the first time they've actually seen high inflation, something that they've never experienced before. And my sense is that this is one reason why the administration is not getting any credit for a lot of the good economic news that you articulated. There's a lot of debate in the economics community, as you know, about what's behind this high inflation. Why are we struggling through this? And the administration has gotten a fair share of blame for it. That the American Rescue Plan, in particular, that's $2 trillion plan, deficit financed, support a lot of growth in the economy very quickly. That's at the heart of the high inflation we're experiencing today. How do you think about that? Is that blame in some way justified? And if not, what's behind this high inflation?
Look, the U.S. economy has just gone through a series of shocks that are really unprecedented. And they led to extreme mismatches between demand, which itself was very skewed by the pandemic, and the supply side of the economy, which was not resilient in the face of first several waves of a global pandemic that was very protracted and then followed in short order by massive spikes in energy and food prices associated with a war. So those are extremely unusual events. And I think what's remarkable is actually how well the economy has performed given that. And if you look at inflation among the G7 peer economies, our inflation, whether it's core or headline, is actually lower than any other G7 economy, which really does suggest that there's no fiscal story that could explain the US experience, given that these other economies saw also large spikes in inflation and are actually having more difficulty seeing those come down. And interestingly, the US economy has seen lower inflation than our G7 peers with a stronger recovery. The other thing I think that's interesting is if you take a look at some of the supply side indices, like the New York Fed supply side index, and you look at the inflation experience relative to that, there's clearly extremely large disruptions on the supply side of our economy that are, again, several standard deviations outside of what you normally see. And those actually track pretty well. So I think, it would be wrong to think about any single cause. But from where we are today, inflation is now 3%. And that is very close to the historical experience, including during the Great Moderation.
Yeah. Okay. So it sounds like, to paraphrase, more on the supply side. It's supply side disruption created by pandemic, the Russian war, that's behind the high inflation. Less so, there's, as you say, lots of different reasons, but less so on the demand side. And connecting the dots back to the ARP, the American Rescue Plan, feels like it's pretty difficult to do at this point.
Look, I think, again, it'd be hard to point to any one driver. Certainly, demand is part of the story. Mismatches between demand that was highly skewed towards the same goods that were very disrupted on the supply side, followed by a surge of reopening demand on services. Those mismatches, I think, are a big piece of it. The supply side is a big piece of it. So there are a multiplicity of causes. But again, here we are today, the U.S. having seen now lower inflation compared to other economies. And that with a stronger recovery really belies that single source story, I think.
Yeah. Okay. So, as you know, there's this widespread pessimism about the economy among economists. I mean, I saw the blue chip consensus forecast came out, I think, the day before yesterday. He asked the question, what to the economists that are participating, what is the probability that the U.S. economy is going to suffer a recession, an NBER defined recession, starting at some point between now and this time next year or next year? And the probability, I think, was like 55, 60%. And that's down from where it was. I mean, I think if you asked that question 3 months ago, it could have been 60, 65%. You hear all these CEOs, and I've never heard, I've been doing this for a long time. I don't remember CEOs ever saying recession's around the corner. And you hear that all the time. So deep pessimism, I think, goes back to the inflation, the thinking that we can't get inflation back down to something we feel comfortable with, back to the Federal Reserve's target, without the Federal Reserve raising interest rates aggressively and ultimately pushing the economy into an economic downturn. How do you think about that? I mean, we're going to be able to get through this period without an economic downturn?
Well, it has been interesting. We've seen these repeated predictions that recession is right around the corner, and the data have instead delivered continued resilience in the economy. We've seen repeated predictions that inflation wouldn't come down absent large-scale job destruction, and yet look where we are today in terms of seeing continued resilience in the job market, along with inflation that is now 3%. We saw repeated predictions that Americans weren't going to go back to the labor force post the pandemic. Here we are today. We have more working age Americans in the labor force than we saw pre-pandemic, and in fact, for about 20 years. So, my general sense is that our economy remains very resilient, and we are seeing inflation come down with a robust jobs market.
Has the job market surprised you? I mean, the strength of the job market?
Well, I think the strength of the jobs market has been a surprise to so many forecasters who really didn't see that rebound in participation. And, that is also true, interestingly, of the overall population, where now, of course, we have retirements, but participation at the aggregate level is now above that pre-pandemic trend. So I think it has surprised everybody that you could see the kind of moderation we're seeing with vacancies coming down and payrolls moderating, and with much greater rebound in participation. Of course, EPOP now for working age at a very high level. So, that kind of a story also underneath it has a lot of people moving to new jobs, to new sectors. We've seen job satisfaction now at levels we haven't seen in 36 years. So there's a lot going on there under the surface, but the overall picture is quite resilient.
So, of course, getting inflation back in is largely the responsibility of the Federal Reserve. Fiscal policy has its limitations with regard to inflation. But are there things that the administration should be doing, would like to do to get inflation back in a more graceful way?
Yeah, so I would say, of course, I mentioned earlier, we have been very focused on restoring a more competitive market generally. And there are certain areas where you can really see the effect of that. And I mentioned earlier, particularly in the healthcare area, just by introducing more competition, you're seeing monthly, yearly, weekly costs coming down. And healthcare costs is a really important area for a lot of families around the country who face difficult trade-offs in meeting those costs. More broadly, of course, we've seen the president bringing the deficit down. We've seen a very large decline, 1.7 trillion over the first 2 years. And we just saw, I think, an important bipartisan agreement that will continue to reduce the deficit, an additional 1 trillion over 10 years. That was a balanced package. Those things, I think, will also contribute to balanced growth in the U.S. And those investments that we're seeing, whether through bipartisan infrastructure, in some of the semiconductor ecosystem, in clean energy, all of those things over a longer period of time will lead to a more resilient supply side of our economy and create the conditions for stronger, more clean growth in the future. And so all of those things together are making contributions.
Let's talk about the risks. Obviously, it feels good at the moment. We're creating a lot of jobs, and recession doesn't feel like it's around the corner, at least not the next few months. But the economy is struggling. Growth is slow by design. The Federal Reserve is trying to get growth down to quell the inflationary pressures. And when the economy is growing slowly, it is vulnerable to anything else that can go wrong. A couple of things come to mind, and I'm just curious, how you think about this. First, it goes back to the Treasury debt limit deal. As part of that deal, there was some negotiation discussion around the end of the fiscal year and the start of the next fiscal year and funding for the government, because unless there's additional legislation, the government's going to shut down on October 1, the start of the new fiscal year. And just listening to what's going on in Washington, it feels like the threat of a government shutdown is consequential. And I'd put the odds, feels like the odds are greater than 50-50 at this point. How do you think about that, and how big a risk is that to the economy here in the near term?
Well, I think the first most important thing is the biggest risk to the economy was the threat of default. And I know you and others have forecast just how significant a threat that was to the recovery. And that has been taken off the table. So I think that is the most significant risk. And the bipartisan budget agreement that was reached does that. That bipartisan budget agreement does include very clear guidelines for spending levels. And certainly the president is committed to honoring that agreement. We have heard, both the House and the Senate voted to approve that agreement, and we would expect Congress to honor that agreement. And that agreement should enable us to proceed smoothly through the end of the year if the appropriators are allowed to do their work in line with the commitments that were made. Now, if that doesn't happen, I think, of course, you're right, that we would see completely manufactured, unnecessary, sort of risk to the economy. But from our perspective, all parties should honor the agreement, and that's the best way to protect our recovery.
Okay. Another risk threat goes back to the financial system. It's hard to believe, but 4 months ago, we were in the middle of a very significant, let's call it a banking crisis. It felt like a crisis, at least to me. And I think the government response was very helpful in quelling the crisis, at least up until this point in time. The bank term funding program from the Fed, the very aggressive response by Treasury and other regulators to come in and resolve troubled institutions and ensuring depositors, whether they were below or above the 250K. But, the underlying cause of the stress in the system is still evident. Interest rates, the Fed's still putting its foot on the brakes. Short-term rates are going higher. The yield curve is still inverted, which ultimately makes it pretty difficult for the financial system to kind of operate if that continues for a long time. I've got this image in my mind of the system is just shaking under the stress, and it feels like, I don't know if there anything such thing as a gasket anymore, but it feels like a gasket might break, at some point. How concerned are you about that potential threat? And am I being overly dramatic here? Are there things that the administration, policymakers should be doing to mitigate that risk or reduce that potential risk?
Yeah. So first, I would say, of course, it is incumbent on us to be carefully monitoring for risks to the financial system. And I think the response that was taken to the stress that we saw in some of the regional banks, it was a very strong response. It gave Americans confidence that their deposits are protected. And of course, it was very important for managers and the owners of those institutions to face the consequences of having very poorly managed their risks, and in particular, not anticipating well the risks of a rising rate environment, which was clear for everyone to see. In terms of going forward, now obviously today's data and the string of data that we've been seeing does give a positive outlook in terms of inflation coming down, and that's very beneficial for the overall resilience of the economy. But supervisors and bank senior executives, it's incumbent on them to be carefully managing the risks. And our sense is that liquidity is actually being managed much better at some of these institutions where regulations had been weakened prior to that. And of course, we, capital at many, particularly at the core of the system, the large banks were just tested, and we have a lot of capital there. But it's important for senior executives at institutions to be carefully monitoring for all manner of risks and to continue strengthening balance sheets and managing liquidity.
Okay, let's turn to your speech and your focus on kind of supply side. By the way, who came up with Bionomics? Where did that come from?
So my understanding is that this is a term that's been used by a variety of outside commentators. So the president. It
wasn't you.
It was certainly not me.
Okay. I like the idea of embracing it, though. That's very good. So let's turn to that. And the supply side policies, that would include the infrastructure legislation, that would include the CHIPS Act, that would include the Inflation Reduction Act, all very substantive pieces of legislation that are going to play out over a long period of time. And they are geared towards promoting the supply side of the economy, the supply side economy. But one of the near-term issues is the tight labor market. And executing on these policies. I mean, to build roads, you need people to be able to, work. And if you look at construction trades, interestingly enough, it's usually construction trades that are laying off aggressively in a high rate environment, and they're holding their own. I mean, they're not adding a lot to payrolls, but they're not laying off, at least in aggregate. So is that a significant constraint on the ability to execute here, particularly on infrastructure, but also on chips and ultimately the IRA as well?
Yeah, so I think, as you know, we think about these policies as working over a period of time to address and strengthen various parts of the supply side of the economy that had become bottlenecks. But if you look at the overall fiscal stance in terms of the contribution to aggregate demand, fiscal impetus has actually come down a great deal. So in that sense, what we're seeing with these investments is they are creating jobs, often very good jobs, skilled jobs, jobs that pay well. And that's leading to reallocation among different projects, potentially different parts of the economy. But we think about it again as the creation and reallocation of employment, deploying it, for instance. We just hadn't been making infrastructure investments for a very long period of time that are necessary. And there's now, I think, a well-documented deficit. And so that is an area where, we're going to see expanded employment, and we may see some reduced employment in other areas that are, not as urgent and where the economy is not expanding as much.
Yeah, and I know you're focused on execution now because the legislation has passed. You've got the funding. You want to get going and you want to show results. Are there any other significant constraints out there on the ability to execute in an efficient and effective way that we should be on the watch for? Labor being one of them, but are there other?
Yeah, so I would say that it's always a large set of really important pieces need to fit together well in order for these projects to move forward. But what's important to emphasize is that the way that the IRA is structured, for instance, this is really creating incentives for the private sector, and a good piece of the CHIPS and Science Act as well. So it's really creating better conditions to attract private sector investment, but then it's really the private sector that is putting together the necessary financing and the construction projects, negotiating those project labor agreements in some cases. And the private sector, is very skilled and expert at doing this. And so a lot of those challenges are being undertaken by, businesses that have been in these areas for a long time. And we are working diligently to try to help businesses navigate challenges wherever they arise.
Let's switch gears a little bit, and we've been focused on the here and now, the near term and the intermediate term. Let's think about the longer run in a few issues. One is the U.S.-Chinese relationship. That's pretty vexed. Ever since the Trump trade war, the trade wars that were engaged under President Trump, it seems like the relationship has gone more or less sideways. And the administration is working really hard. Treasury Secretary Yellen's a visit to China last week is a good case in point to try to have a working relationship, which makes a lot of sense. But it feels like we're decoupling, that we're moving in different directions here. And if you look at bilateral trade, if you look at bilateral investment, they're certainly down from where they were. And a lot of moving parts could be for lots of different reasons, but it feels like we're just moving apart from each other. Am I characterizing that correctly? Is that a correct way of thinking about it? And if so, what are the ramifications of that for the economy going forward?
Look, I think what you are describing is, as you said, it's really a longer term process of continuing to see diversification of supply chains. Generally, I think actually two-way trade had been very strong and had increased a great deal. And I think the most recent quarter might be a little softer, but the reality is we continue to have a very large set of two-way flows, trade and investment with China. But it is also the case that it's important for us to narrowly make sure that we are attending to national security concerns. And so the President Biden has taken a number of very narrow, targeted actions. Really, we haven't seen any larger scale actions of the sort that we saw under the previous administration. These have been very targeted on national security. And of course, within the broader emphasis, I think that is not that is among the private sector as well, just being attentive to areas where you may be excessively dependent on a single source. And having seen how those kinds of dependencies served businesses very poorly during the pandemic, I think there's just been a general move to diversification. But, we have seen a series now of visits. We saw Secretary of State Tony Blinken have good meetings, Secretary of the Treasury Janet Yellen, Special Advisor John Kerry has announced that he's going. So it's important for us to continue working with China. These are obviously, it's a very important relationship. And so we are seeing those dialogues and we'll continue to engage.
Okay. One worry is that this decoupling might lead to higher rates of inflation. The idea being that, if you go back after the WTO and the entry of China onto the world scene, that that caused prices to fall and was a deflationary force, up until, again, President Trump. Going forward with the decoupling, we're going to see the opposite of that effect, and it will add to inflationary pressures.
So, look, I'm not seeing evidence of decoupling. I'm just seeing evidence of diversification. And, again, I think that both governments and businesses just were given a wake-up call during this extreme set of events during the pandemic and then the war, that you need to be attentive to the resilience of supply chains, in addition to being attentive to efficient resource use. And so that's why you're seeing this kind of diversification.
Okay. I am going to turn to the audience in just a minute, so be prepared. One more big long-term issue, the deficit, big problem. If you look at the CBO, Congressional Budget Office projections under current policy, which, by the way, under current policy, the tax cuts implemented under President Trump, they will expire. But under current policy, our fiscal outlook feels very unsustainable to me. The debt to GDP ratio is almost 100% now. Under current policy, a decade from now, it's going to be 118, 120% and headed straight north. How big a deal is this, and how's the administration thinking about this?
So look, I think fiscal sustainability is a very big deal. It's very important to President Biden. And, we did see a large reduction in revenues as a share of GDP under the Trump tax cuts. Obviously, last year was a little bit of an exception just because of some special factors. But I do think we have to recognize that revenues as a share of GDP it came down structurally, and we need to get back to more normal levels and perhaps a little bit above that, just to take into account demographics. The president would like to see the tax system be more fair, would like to see those additional revenues coming from addressing some of those tax cuts that went to the top, that may have gone to large corporations, and not affecting people who are earning less than $400,000 a year. But I think, as you said, there's really an opportunity in 2025 to rethink the revenue side and to do so in a way that's fair.
Anything on the spending side?
So we just concluded an agreement that brings down spending by about $1 trillion over the next 10 years. And of course, we'll continue to have conversations going forward. But right now, I think, if you look at what happened a week after we concluded this deal that was supposed to be about reducing the deficit, the Republican caucus in the House introduced new proposals that would cost about $500 billion of tax cuts for business. And so we really do have to be attentive to the revenue side and make sure that we get that back up to levels that will lead to fiscal sustainability in a way that is fair.
Okay, great. Let's turn it to the audience. Any, yes, sir, right here. Or maybe I should let you pick.
No,
Okay.
please. I'm happy to take questions.
Thank you very much. Paul Das from BGD Holdings. Thank you. I was having briefly a conversation with you before we got the session underway. In terms of the Biden economics pillar of bottoms up, middle out, as you see the job markets in terms of the number of jobs tightening and the pace at which you're seeing the rise in the layoffs. One of the reports I read last week in Bloomberg was a piece which suggested that close to 90% of the most recent layoffs happens to be at the bottom end of the round, affecting disproportionately communities who for the first time have gained these jobs and seen the wage growth. Curious to get your thoughts as a function of monetary policy and otherwise as we continue this trend. If this begins to happen more and it sort of contributes to pre-existing structural issues around income inequality, and you lay over it the structural issue like affirmative action, which then is sort of predisposing again a cycle of outcomes. So curious to get your thoughts. Don't know if you've seen that report, but thank you.
Yeah. So look, I think what is a high priority is to see a sustained, resilient jobs market, because we know that those sustained periods of good performance in the job market is disproportionately beneficial to groups that have historically been challenged in the labor market. So we tend to see the strongest participation rates, the best employment outcomes, rising wages among groups like African Americans and Hispanic workers, disabled workers. Those have not from month to month, but looking across, sort of an average several months, we actually have seen quite good outcomes there in terms of employment and participation. In terms of earnings, we've seen better real earnings among production and non-supervisory workers who previously had not been doing as well. So far, the patterns have been very good. Outcomes for women have been particularly strong. And again, early on, you heard a lot of predictions that you weren't going to see women going back to the labor force and getting good employment outcomes. That has turned out not to be true, fortunately. And so the probably the most important thing we can do is try to have ongoing stable growth, a resilient job market, and to continue to see groups that have historically not fared as well improving in terms of participation, employment, and earnings.
We have time for one more question. Barbara, you'll be proud of me that this clock is not working, but I think I'm on time. So, and that's a dangerous thing, not have a clock for an economist. Yes, sir.
Hi, Fred Hochberg. I served as the chair of the Exim Bank under President Obama. Lael, two questions as I listened to both you and Mark. Many people used to think that Europe was very inflation averse based on what happened in the 1930s. We were more recession averse based on depression. But is the political takeaway what we're doing with right now that we may become more inflation averse in our policymaking overall? Because is that going to be the takeaway from this period of time? And the other question, something unrelated, is can we ever use taxes to also tame inflation, or is that economically not sound, or is just politically impossible?
So I think on the first, look, I think what we've seen in Europe as well as in the US and other jurisdictions is just that our economies have contended with these massive unprecedented shocks. And policymakers, particularly on the monetary policy side, they have frameworks and they are pursuing those frameworks. The shocks are hitting economies differently. Obviously, for Europe, their energy dependence on Russia was different than the way the U.S. Energy sector works. And as a result, they were disproportionately, I would say, affected by the events in Russia, Ukraine, although they affected all of us in terms of food prices and energy prices. So in terms of, I think generally speaking, right now, we're seeing improvements everywhere, but we're seeing really very good results here in the U.S. that are perhaps better than elsewhere. And we expect those improvements to continue, certainly on bringing inflation down. On taxes, I mean, it's tax policy takes time, and often short-term countercyclical policy. That's the reason that central banks have independence and have short-term tools. It often is hard to have short-term changes in tax immediately affect the economy in ways that lead to macroeconomic stabilization.
Barbara, are we done? We're done. Okay, great.
Thank you.
Thank you, Bob.
Well, many thanks to you both. This was just a terrific conversation, and we really appreciated you both being here today. This evening, we have a member peer exchange event. Is it time for school choice in New York? That's going to be sponsored by club member Stephen Looney, who's managing director over at Pell Davies and Company, and starts tonight at 5. Tomorrow, July 13th, we have, as part of our author series, a webinar with Andrew Liveris, the former chair and CEO of Dow Chemical. On the 18th, next week, we have a one member, one candidate prospective member event. We'd like to invite you as members to come together and bring candidates that you think would be suitable for membership in the Economic Club. That's nice, small cocktail gathering, very pleasant experience. I'll be there. A lot of people will. On July 19th, we have another webinar for the author series with Ambassador Robert Lighthizer, former U.S. Trade Rep, and he will be in a conversation with Fred. On July 20th, we have a second member peer exchange event on a topic that's quite hot, advances in AI technology regulation and the impact on society. This is an in-person meetup sponsored by club member Nick Adams, managing partner at Differential Ventures. And then on July 24th, we've added to the calendar a luncheon event with the Honorable Lena Khan, the chair of the Federal Trade Commission. That will, I'm sure, be a well-attended event, so be sure you try to reserve a spot. July 26th, Paula DiPerma, the author and special advisor to CDP, will be in a webinar conversation on her new book and a discussion with former board member and club member Abby Cohen. And on July 27th, we'll have Jesse Van Tol, President and CEO of the National Community Reinvestment Coalition, for a webinar. So please be sure to keep checking the website and watch for your emails as we continue to add to the calendar. And we have a very good fall calendar shaping up. We'll be starting to open those events actually very shortly, so you can start to get them on your calendars for September, October, November, December. We also would always take a moment at this point in our programs to thank the 362 members of the Centennial Society, those of us joining us today, for their contributions, which continue to provide the financial backbone of support for our club, which is, of course, a 501c3. So thank you to all who attended virtually. We're going to say goodbye to you. And for everyone else in the room, please enjoy your lunch. Thank you.